Welcome to CFP Exam Prep. Today we're diving into stock bonus plans and net unrealized appreciation, a crucial topic that frequently appears on the CFP exam. Let's break down stock bonus plans. These are qualified retirement plans where employers contribute company stock to employees instead of cash. Think of it as a 401k, but with company shares instead of mutual funds. The key advantage is that employees can benefit from company growth while employers can maintain cash flow and create employee ownership mentality. Understanding net unrealized appreciation, or NUA, is where many test takers stumble. NUA is the difference between the cost basis of employer stock when it was contributed to the plan and its current market value when distributed. The beauty of NUA treatment lies in its tax advantages. Here's a practical example. Imagine an employee receives company stock worth $100,000 through their stock bonus plan. The original cost basis when contributed was $20,000. The NUA would be $80,000. Now here's where it gets interesting for the exam. When taking a lump sum distribution of employer stock, you only pay ordinary income tax on the cost basis immediately. The NUA portion isn't taxed until you sell the shares, and when you do, it's taxed at long-term capital gains rates, not ordinary income rates. This can mean significant tax savings. A common mistake on the exam is confusing the timing requirements for NUA treatment. To qualify for NUA tax treatment, the distribution must be a lump sum distribution following a triggering event. These events include death, reaching age 59.5, separation from service, or disability. The entire balance must be distributed within one tax year. Students often miss that partial distributions don't qualify for NUA treatment. Another tricky area is understanding what happens to additional appreciation after distribution. Any further gains above the NUA amount are treated as capital gains, with the holding period starting on the distribution date. This detail often appears in exam questions designed to test your depth of knowledge. When advising clients about NUA strategy, the exam might present scenarios where it's not the best choice. For instance, if the NUA is small or if the client needs immediate income and can't afford the upfront tax hit on the cost basis, other distribution strategies might be more appropriate. Here's a test-taking tip. When you see a question about stock bonus plans or NUA, immediately look for these key elements. First, check if it's a qualifying triggering event. Second, verify if it's a lump sum distribution. Third, identify the cost basis and current market value to calculate the NUA. Finally, consider the client's tax situation and immediate needs. Remember, while the NUA strategy can provide significant tax benefits, it's not always the optimal choice. The exam tests your ability to recognize when it's advantageous and when other options might better serve the client's needs. Understanding these nuances about stock bonus plans and NUA treatment isn't just about passing the exam. It's about being able to provide valuable guidance to future clients who might benefit from this sophisticated tax strategy. Focus on understanding the triggering events, distribution requirements, and tax implications, and you'll be well prepared for exam questions on this topic. Keep practicing with scenarios involving different market values, cost bases, and client situations. This will help solidify your understanding of when NUA treatment makes sense and when it doesn't.